Hey guys, welcome back for episode 3 of Odds Are, your weekly S&P options forecast. I'm your host, Chris Torres. So last week, we threw out a number. We said 38.79 was the number to watch. We said that if the market were to breach below that point, we were expecting some rough times ahead. And the market did in fact breach that point very early in the week, and it went on to continue downward and breach the 38.66 level. And it continued down to settle at around 38.09 by Friday's closing. So what does that mean? First, let's take a look at the relative view. This was last week. You can see the market performance here, and you see where our forecasts were. You can see what I was describing, that it breached down below those 2 points, and that it actually settled within the expected settlement range. So that sets us up for this week, where we are expecting that bearish sentiment from the breach of the parabolic SAR to continue on. And we already ran the numbers. I'm not going to put them back up on the screen, but needless to say, we are looking for some more downside moves in this week ahead, unless something fundamentally were to occur that would reverse that direction for the market. Let's go now and take a look at the moving averages. So one thing you'll note right away is that the short-term moving averages are no longer bullish. They are now neutral. Now, that is expected because of the movement in the last week in the short term, but you'll see that the medium-term ranges, moving averages, and the long-term moving averages are all still bullish. So it takes quite a bit to make those flip over. You usually don't see medium-term and long-term moving averages just flip from bullish to bearish, and so we're kind of starting that process now, where the short term will roll over first, and if this continues to be a prolonged downward move, then eventually you'll see that flip to bearish, and then the medium term will flip to neutral, and so on and so on. But as of right now, we're still in very, very early stages. We're not predicting anything beyond the next couple of weeks, but you already know where we stand for this week coming up. Let's take a look now at what the breach points are that we are forecasting for this week. Here we go. So the top side breach point is going to be at 38.96, and the downside breach point is going to be at 37.47. Odds are 81.26% that we will have a breach of one of those 2 points. Let's now add in the layer of the expected settlement range. The expected settlement range is going to be between 36.98 and 38.69. Notice that we didn't even mention the parabolic SAR for this week because we are not factoring in a new parabolic SAR. Rather, we are looking for the effects of the breach that just occurred in the previous week. So we've got these 2 indicators in play, the expected settlement range and the breaches, which leads us right into what you guys already know is my favorite part of the show. I didn't see that one coming. Now, if you look at, and I'll pull this back up actually on the screen here, if you look at the breach points in relation to the expected settlement range, what do you notice? You will see that the top side breach point is above the expected settlement range, and the downside breach point is within or above the downside expected settlement range. So it would mean that for the market to stay within the expected settlement range, to breach to the top side, it would have to go above this range, then pull back down into the settlement range. Whereas if it were to go to the downside, it could very easily breach that breach point and still stay within the expected settlement range. Now, that doesn't mean that's exactly how it's going to play out, but odds are in favor of the market breaching the lower breach point and then still staying within the expected settlement range. It would be a lot easier for the market to do so. And pairing that with the fact that we're already expecting some bearish moves, this is probably what I would put my money on, is the fact that we are looking for more of a breach of the downside and staying within that expected settlement range. All right, so now the quote of the week. And the quote of the week, actually, I cannot ascribe to any one particular person. This is an old adage that's been floating around Wall Street, so there's probably multiple stories about where it actually originated from. But it says, bulls get rich, bears get rich, hogs get slaughtered. Now, that's pretty graphic, but we can all hopefully appreciate what we're actually getting at there, which is that you can make money with strategies that take advantage of upward movements, and you can make money by taking advantage of strategies that go to the downside. But once you get greedy, that's where you lose it all. And so every week on this show, we're going to give you guys some forecasted ranges, and hopefully you'll be able to take advantage of those. But please, guys, don't get greedy. If something happens, if the market breaches beyond a certain point that we were expecting, don't say, hey, I think it could go down another 100 points or up another 50 points or anything like that. These ranges of probabilities are based on historical data, and they are not meant to give you leeway or permission to get reckless. So stay safe, keep trading well, keep your risk management in check, and we will see you guys next week.